Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to make a little money here. My job is not just to entertain, but I'm teaching tonight. So call me 1-800-743-CNBC. Tweet me, Jim Cramer. You either believe in artificial intelligence, or you should just stay away.
Don't buy.
You trust Nvidia and Jensen Huang, or you can just go own some drug stocks and some food stocks. And you know what? Why don't you just go buy some rails?
All aboard!
Nobody demands that you buy the so-called hyperscalers. If you don't have confidence in these AI stories, the whole investing world, look at this, all these stocks are your oyster. There's no need to obsess over this stuff. Welcome to the kind of zero-sum investing logic that has kept people from making millions upon millions of dollars because they live in fear. They only know to sell when stocks are going down and buy when they go up. And that is a terrible strategy if it's a strategy at all. You should never buy anything if you don't trust enough to buy more on weakness. Trust is how you benefit from stocks these days. Dow, like any other day, shot up 664 points. Trust. The S&P jumped 0.91%. Trust. And then NASDAQ gained 0.67%. You're not going to catch these gains if you don't trust. That said, if you go to own tech, you need to know the landscape. For example, everyone who's in the Magnificent Seven should recognize that they didn't become magnificent by missing quarters and screwing up. They didn't rise to these lofty levels by being fooled by other companies or being duped or dropped as vendors because they're second rate. Before I go into why I trust the people who run these companies, and here I'm speaking, of course, of Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, let me just say that there are literally hundreds of big capitalization companies that don't require a lot of fortitude to own. Today, Abercrombie & Fitch and Kohl's, two retailers, screamed higher on better-than-expected results, finishing up 38% and 43% respectively. Those are more like takeover bids than earnings surprises. We have Best Buy on tonight, and wow, what a quarter they reported. Nothing's keeping you from owning those stocks instead of tech. But as you may know from How to Make Money in Any Market, I am a huge believer in growth stocks. And none of those three can truly be considered a growth stock, at least not yet. These three and so many former growth stocks are what draws me to the hyperscalers for my charitable trust. Now, we may own many stocks from other universes, drug stocks, aerospace, materials, data center builders. They have long-term growth stories. But they're not turbocharged with the resources of these gigantic companies. That's what always brings me back to the Mag 7. These stocks are prominent because of their success. The companies they represent have bountiful profits, which is why they could rise to their lofty trillionaire status in the first place. It's why I don't kick them out when they're down. In fact, it's why I might buy them for the trust. I'll admit that they have a bit of the Houdini in them. Tesla was a car company, and stock rallied as a car company, and then when things got very competitive in electric vehicles, the stock got hammered and hammered and hammered again. But when Tesla fell from the 400s to the 200s at the beginning of this year, an amazing thing happened. The stock, not the company, the stock, it was always the same company, morphed into a chit in the great game of self-driving and robots. CEO Elon Musk simply changed the narrative, and the street bought it. That perception has allowed the stock to regain almost all of those lost points, even though it's pretty much the same company it was before the decline in electric vehicle profits. And that's what the Magnificent Seven do. Which brings me to why I'm doing this. The contretemps between Nvidia and Alphabet, with Alphabet de-emphasizing Nvidia's chips by relying on its own chips made by Broadcom. Those chips are supposed to be so good that Meta, a competitor, is actually said to be contracting with Alphabet to get its hands on them, perhaps so they can replace the same high-priced semiconductors from Nvidia. On this news, Nvidia stock has had the living daylights kicked out of it. Alphabet had been a huge client of Nvidia, and the press clips say that it's going to adopt its own chips far more than the ones owned by Nvidia. Alphabet stock has been as hot as Nvidia stock is now ice cold. It got colder last night when a tech publication reported that Meta is willing to buy these same chips from Google at a considerable savings. Perhaps there could be some license agreement that includes Broadcom, the general contractor for Google's chips, as Broadcom CEO Hock Tan is on the board of Meta. Now, you could argue, so what? NVIDIA's got a ton of business. But NVIDIA just reported what seemed like a bang-up quarter. Instead, well, guess what? The stock got banged up. Injured reserve style banged up. NVIDIA was at 186 before the quarter. but then it fell to 180 after its report. Today, it dropped further to 177 on this meta news, down $4.73. But it did fall as low as $169. Now, considering it traded at 212 at the end of October, 169. I mean, that is quite an amount of loss.
The House of Pain.
Let's add a few more indignities to the story of Nvidia. Meta jumped nearly 4% today because investors bought the stock hoping that these new chips from Google could lead to better gross margins for Meta. That's another Mag 7 about to make a comeback as it benefits from not having to spend a lot of money with Nvidia, at least the critics say. Now, you could argue that all this is just inside baseball if it weren't for the fact that, well, let's say a couple of other facts. First, the super large customer of Nvidia, another one is OpenAI, and that's been the subject of stories about a seemingly precarious balance sheet. Insult to injury, there are short sellers circulating with what I regard as dubious condemnations that include linking Nvidia to companies with fraudulent accounting that amounted to criminal enterprise. There are people saying that Nvidia is the next Enron, which I've got to tell you is categorically absurd. So why not just dump Nvidia if you can't take the pain? All right, I play with an open hand for my trust, so I want to explain why I won't give up on this one. I want to explain why I say own, don't trade the stock of Nvidia. First, historically, it's been a bad idea to dump any of the Mag 7 out of fear. We sold Google for the charitable trust at a considerable gain, but we left the darn double on the table. I thought Google would be hobbled by antitrust woes and a judge who seemed bent on punishing it as a monopolist. Instead, the judge changed his mind and blessed the company, including the $20 billion payment to Apple to be the sole built-in search provider. I thought the Gemini, their AI product, would cannibalize Google's amazing search margins. No, it complemented them and enhanced them. The only reason I'm not kicking myself is we took our profits from Google and invested them in Broadcom, which has been a really outstanding performer. Still, it was a mistake to throw in the towel because of fear. And you know what? I feel the exact same way about Nvidia, and I've been thinking about this nonstop since they reported. See, these near-term concerns, they got some validity, of course. I'm not denying them. So did the antitrust action against Google. They most certainly matter, just like the possible cannibalization of Google by Gemini. For all we know, this may be the beginning of the end of Nvidia's AI dominance. I just don't see it like that, though. With the exception of the bogus accounting charges that I won't even dignify with a response. I wish Nvidia hadn't alluded to them either, by the way. I think their problems are not insurmountable. In fact, these remind me of the same problems I've heard all the way up from when I liked Nvidia, when it was just a several $100 billion enterprise instead of the $4 trillion enterprise it is today. I saw so many people leave the stock for so many other reasons that are just like these. That's why I say own it, don't trade it, Nvidia. So the bottom line, if you don't like Nvidia, you don't have to own it. Nobody's putting a gun to your head. But let me give you a little coda here, because I'm kind of angry about this. Here's your hat. What's your hurry? And don't let the door hit you on the way out of Nvidia. Let's speak to Shelley in Virginia, please. Shelley.
Hey, Jim, I love watching you on Squawk and Mad Money. You're the best.
Thank you, Shelley. Hey, Faber's a pretty funny guy, you know? And, of course, Carl's a great, Carl's Rock Gibraltar. What's going on?
My question is on Disney. I've had Disney for a long time. It's gotten pretty beaten down. Is Disney a buy, sell, or a hold?
I think Disney's a hold, and I say that because I think it's too cheap to give away. But I felt higher prices that I just wanted to say, you know what, this thing could go to 95. Maybe I take a look at it there. But it doesn't have the earnings. It had a quarter that everyone thought was good, and it was just hated. What happens if it has a not great quarter? I say look out. I'm going to go to Ken in California. Ken.
Hey, Jim, thanks for taking my call, man. I'll make this short and sweet for you.
All right. No problem.
This company, they got decent cash flow, supports a good dividend, and I'm not sure if I can mention their name, but you got one of the biggest investors out there gobbling up a third of their shares. So hit me with it. What's up with SiriusXM?
All right, look, I think you need to have more car sales. You need to have more growth in used cars. You need to have that before you can just say, you know what, it's time to load the boat up Sirius, and that's the problem. All right, anyway, look, you can either lean into the AI trade or just stay away. I don't care. Don't like Nvidia? You don't have to own it. On Mad Money tonight, Best Buy just hiked its full-year outlook, so could consumer tech be the best new way to play the retail space? I'm checking in with the CEO fresh off the company's report. Then there'll be a lot of publicly traded representation on your Thanksgiving table this week. I'm covering those companies and see if you should carve some space in your portfolio for these names. And up over 40% in the last 6 months, the life science company Agilent, letter A, has been a quiet winner. Could the momentum continue? I'm sitting down with the company's top brass, so stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.